Hello and welcome to a summary of The Intelligent Investor by Benjamin Graham. Today's video is sponsored by Audible, where you can download this classic investment text and get everything that the book has to offer. We highly encourage you to purchase the Audible version today. It supports the author and our channel. With Audible, you can listen to this book and thousands of others on the go, at your own pace, and with the added convenience of narration. Plus, as a member of Audible, you'll have access to exclusive sales, discounts, and a free book every month. So don't miss out. Get The Intelligent Investor on Audible now and start listening today. Please check the link in the description to find out more. Right. Let's get on with the video. The Intelligent Investor by Benjamin Graham is a classic investment text that discusses the principles of value investing and offers guidance for making informed investment decisions. The book is divided into two parts, the first for the defensive investor and the second for the enterprising investor. Chapter 1. The Investor and Investment. In this chapter, Graham discusses the difference between the intelligent investor, who is patient and disciplined, and the less informed investor who is prone to costly mistakes. He also emphasizes the importance of having a clear understanding of one's financial goals and the role that investments play in achieving those goals. Graham advises the investor to approach investing with a long-term perspective and to avoid making decisions based on short-term market fluctuations. Chapter 2. Investment versus speculation. In this chapter, Graham defines speculation as a focus on short-term price movements and investing as the analysis of a company's fundamental value. He advises the investor to focus on the underlying value of a company and to avoid being swayed by market speculation. Graham also stresses the importance of maintaining a diversified portfolio and avoiding overconcentration in any one security or industry. Chapter 3. The defensive investor. The defensive investor, who is risk-averse, should focus on minimizing risk by diversifying their portfolio and investing in a manner that allows them to sleep well at night. This includes investing in high-quality, stable companies with a long track record of profitability and strong financials. The defensive investor should also be willing to hold onto their investments for the long term and to avoid trying to time the market. Chapter 4. The enterprising investor. The enterprising investor, who is willing to put in more effort and take on more risk, must be knowledgeable and analytical in order to make informed decisions. This includes carefully researching and selecting undervalued companies with good growth potential. The enterprising investor should also be willing to actively manage their portfolio and to make buy and sell decisions based on their analysis of a company's fundamental value. Chapter 5. Portfolio policy for the defensive investor. The defensive investor should diversify their portfolio across multiple industries and choose high-quality, stable companies. They should aim for a balance between safety and return, with the primary focus being on minimizing risk. The defensive investor should also be willing to hold onto their investments for the long term and to avoid trying to time the market. Chapter 6. Portfolio policy for the enterprising investor. The enterprising investor should carefully research and select undervalued companies with good growth potential and be willing to actively manage their portfolio. They should also be willing to hold onto their investments for the long term, but with the flexibility to make buy and sell decisions based on their analysis of a company's fundamental value. The enterprising investor should aim for a balance between risk and return, with a focus on earning higher returns through careful selection and active management of their portfolio. Chapter 7. The investor and market fluctuations. Market fluctuations are a normal and expected part of the investment process. The intelligent investor should not panic in response to short-term fluctuations and should instead stay the course and focus on their long-term financial goals. Graham advises the investor to avoid trying to time the market and to instead maintain a diversified portfolio and focus on the underlying value of their investments. Chapter 8. Common stock and uncommon profits. To earn uncommon profits, the investor must seek out undervalued companies with good growth potential and be willing to hold onto their investments for the long term. This requires careful analysis and a deep understanding of the company's fundamentals, including its financials, management, and industry trends. The investor should also be willing to diversify their portfolio and avoid overconcentration in any one security or industry. Chapter 9. Investment policy for the insurance company. Insurance companies should follow a conservative investment policy, focusing on safety and stability rather than potential for high returns. This includes investing in high-quality, stable. Chapter 10. Investment policy for pension funds. Pension funds should also follow a conservative investment policy, with the goal of providing a steady stream of income for the fund's beneficiaries. Final thoughts. The Intelligent Investor is a comprehensive guide to the principles of value investing. It offers timeless guidance and is a valuable resource for anyone looking to make informed investment decisions and achieve long-term financial success. The book's principles are still relevant today, and it is well worth purchasing and reading.